Hello students, I'm Vipul Mittal, and in this session I will discuss accounting for treasury stock using the retirement method. So a company may purchase shares of its own common stock. You call such shares shares or treasury stock. So company purchases its own shares of common stock. Now the question is that how do you account for that? Two acceptable methods to account for treasury stock under US GAAP are retirement method and cost method. In this video, I will discuss retirement method. So these are the only two methods that are acceptable, retirement method and cost method. Par value method is not an acceptable method under US GAAP. So you do not account for treasury stock using the par value method. So an entity purchases shares of its own common stock. And how do you account for that using the retirement method? So under the retirement method, any gain on retirement or constructive retirement of stock acquired should be credited to additional paid-in capital. So you are following the retirement method. So this is formal retirement and constructive. This is not formal retirement, more of an accounting retirement that you are considering it retired. When I say retirement, it is cancellation, redemption. All right. So you purchase shares of your own common stock and retire them. This retirement may be formal or constructive. If you have any gain on this retirement, it should be credited to additional paid-in capital. But how do you calculate this gain? This is excess of par value over cost of shares. So that is par value minus cost. So if the par value is $10 and you have paid a lower price, $8, to buy shares of your common stock, then you have a gain of $2. And this should be credited to additional paid-in capital. All right. When you buy shares of your own common stock and retire it, there may be a loss. So any loss on retirement or constructive retirement of the stock acquired may be allocated between additional paid-in capital and retained earnings. Maybe. So you have an option that you allocate it between additional paid-in capital and retained earnings. Or you have an alternative that do not allocate it between additional paid-in capital and retained earnings, but transfer the entire loss to retained earnings. Transfer the entire loss to retained earnings. Do not split that loss between additional paid-in capital and retained earnings. This is an alternative that you have. All right. Now, if you decide to allocate it to retained earnings, the entire loss, all right. But if you decide that it should be split between additional paid-in capital and retained earnings, then there is a limit on the amount that can be allocated to additional paid-in capital. So you want to allocate a part of the loss to additional paid-in capital, but there is a limit on the amount that can be allocated to additional paid-in capital. Or in other words, there is a limit on additional paid-in capital that can be used to absorb that loss. There is a limit on the amount of additional paid-in capital that can be used. And what is that limit? A portion of the excess allocated to additional paid-in capital should be limited to the sum of both of the following. Pro rata portion of additional paid-in capital on the same issue. So here we are actually talking about original issue premium. all additional paid-in capital arising from previous retirements. We are talking about gains from earlier retirements and net gain on sale of treasury stock of the same issue. You have not retired. That means you were following the cost method. So net gains on sales of treasury stock of the same issue. This generally would happen if you are following the cost method. So net gain on sale of treasury stock if you are using the cost method. So if you have gain on retirement of treasury stock, it should be credited to additional paid-in capital. But if you have a loss, how do you calculate the amount of loss? It is cost minus par value. It is excess of cost over par value. So if you have bought shares for $15 and par value is $10, so there is a loss of $5. How do you account for this loss? One alternative you have is that you transfer the entire $5 loss to retained earnings, or you can allocate this $5 to additional paid-in capital and retained earnings. That is, you want to use additional paid-in capital, but there is a limit on the amount of additional paid-in capital that can be used. The limit is sum of these two things: original issue premium on the shares retired and additional paid-in capital arising from previous retirements. So if you have bought the treasury stock and sold it, not retired it, you have bought it and sold it, that is, you are using the cost method, then you have gain on sale. If you have bought it and retired it and you have gain from retirement. Let me explain this with an example. So you are following the retirement method to account for treasury stock. We're talking about X company. X company issued 20,000 shares. Par value is $10. These were issued at $12 per share. This is original issue price. All right. And these were issued, let's say, in year 4. Now it is year 6, and company purchases 300 shares from open market. All right. Let's take a date. So on February 10, year 6, company purchased 300 shares from open market at let's say $9 per share. Okay. Now company using the retirement method. So company retires these 300 shares or constructively retires these 300 shares. The journal entry does not change whether the stock is retired or constructively retired. So these 300 shares are retired. So common stock. And you pay cash. So 300 shares, par value is $10. So $3,000. How much X company has paid? $9. 2,700. There is again difference between amount paid and par value. And this gain is credited to additional paid in capital. So you have additional paid in capital from retirement of treasury stock, and you credit this amount. This is gain. All right. Now, company again purchases in the same year on August 25th. Let's say. So company purchases 400 shares this time from open market at $14 per share. And this price is higher than the par value. All right. What journal entry? Common stock, debit, 400 shares, $10. It is $4,000. And how much cash is paid? 400 shares and $14 per share. 5,600 is paid. There is a loss of $1,600. $1,600 is paid more. What you are going to do? You have two options here. You can transfer the entire loss to retained earnings. All right. So option one, transfer the entire loss to retained earnings. Plug figure. Or you can allocate this loss of $1,600 to additional paid in capital and retained earnings. But in case you decide to use additional paid in capital, then there is a limit on the amount of additional paid in capital that can be used to write off this loss. There is a limit on the amount of additional paid in capital that can be used. Or there is a limit on the amount of loss that can be transferred to additional paid in capital. What is that limit? This is the limit. Original issue premium and any additional paid in capital from earlier retirements, if you're following the retirement method, if you're following the cost method, any gain on sale of treasury stock. Here we are following the retirement method. So you will see that, okay, what is the original issue premium? In this example, it is $2. And what is gain from earlier retirements? If there is any gain. In this case, company purchased on February 10th and has a gain of $300. So this can be used. Let's see how we use this. So let's talk about option two, where you allocate $1,600 to additional paid in capital and retained earnings. So what journal entry you will do? Common stock debit, $4,000. And you credit cash, $5,600. Loss is $1,600. You allocate this loss of $1,600 to additional paid in capital and retained earnings because you want to use additional paid in capital, but there is a limit on the amount of additional paid in capital that can be used. This limit is original issue premium that was credited to additional paid in capital and any gain on earlier retirements. So what is original issue premium? This is on common stock. And this is 400 shares multiplied by $2. This is the amount of original issue premium. All right. So $800 of original issue premium that was credited to additional paid-in capital is used. What else you can use? What else additional paid-in capital you can use? You can use additional paid-in capital arising from earlier retirements. So what is additional paid-in capital arising from earlier retirements? So here it is, $300 is the amount of additional paid-in capital arising from earlier retirements. So you can use this $300 also. So you can use additional paid-in capital arising from previous retirements. All right. And the remaining loss is transferred to retained earnings. This is plug figure, and this is 500. So in case of a loss on retirement, you have two options. You can transfer the entire loss to retained earnings, or you can allocate the loss to additional paid-in capital and retain earnings. But when you are doing that, you have to be careful that you do not use additional paid-in capital more than the amount allowed. All right, students, I hope this video is helpful in understanding the retirement method. Stay connected. Goodbye.